So the book shows prior to being united in a business combination, Atkins and Watterson had the following stockholders' equity figures. Atkins is the acquirer. Atkins issues 51,000 new shares of its common stock valued at $3 per share for all the outstanding stock of Watterson. Immediately afterwards, what are the consolidated additional paid-in capital and retained earnings, respectively? So what's going to happen here is they purchased the stock for $3 a share. What is the par value? $1 a share, right? So what are we going to do? Basically, Watterson, we're going to eliminate their equity section because we're purchasing the company. And so what we'll want to do here is they're asking us, what does it show in Atkins books once we purchase them? What do we show as the additional paid-in capital? And what do we show as retained earnings? So what we're going to do, I'll open up an Excel. So in Excel, we are going to basically show how much did we purchase the shares for?
$3.
We purchased 51,000 shares at $3 a share. So 51,000 shares at $3 a share, 153, right? Make sense? Then, what is the par value? $1 a share, right? So 51,000 shares at $1 a share is what? 51,000, right? Again, it wants to know not what the entire stockholders' equity section is showing. It's asking us for additional paid-in capital and retained earnings. Okay, so the common stock at par, they don't want to know that. The common stock at par for the purchase of this company is 51,000. We would have to add to that the original common stock at par. So the additional paid-in capital, I'm going to call it PID, paid-in capital, of the new shares is going to basically be the difference between what we purchased it for minus what the par value was of the stock. That's additional paid-in capital just on this new company. Then we want to take into account Atkins shows additional paid-in capital prior to this consolidation is 90,000. So we'll take the original additional paid-in capital on old shares, which was 90,000. So now the new figure we're going to use on the consolidated paid-in capital at fair value is going to be $192,000. Make sense? All we're doing here, we're taking our old figures prior to the consolidation, then based on what they're paying for the company, they issued 51,000 shares at $3 a share. The dollar a share is part of the common stock par value. The additional gets added to additional paid-in capital. Okay? So we take the new additional paid-in capital plus what was on our books prior to show our total additional paid-in capital at consolidation. Now, the next part of this problem asks us what happens with retained earnings? Nothing right now. The retained earnings is $300,000. There's no change in it. Okay? We are wiping out Watterson's stockholders' equity section. So we're not going to be transferring any additional retained earnings. Think about it, guys. What are retained earnings? It's the accumulation of the company's net income minus dividends for the life of the company. Since we're purchasing this company, we're not adding any of their retained earnings. It's starting fresh. Make sense? So the retained earnings isn't going to change. It's just going to be the retained earnings of the old company. Nothing's going to change there. So, guys, what's the correct answer here? The 192 and the 300,000, isn't it? Okay. I think we did this one, but doesn't hurt to do it again. How many of you guys remember doing this one? If you don't remember, we're going to do it. Okay? So, we've got here, on July 1st, True Data Company issued 10,000 shares of its common stock with a $5 par value and a $40 fair value in exchange for all of WebStats company's outstanding voting shares. WebStats pre-combination book and values are shown below with the book values of True Data. So basically what we've got here, True Values book data, WebStats book data information, and then the fair value of various assets minus liabilities. What they want us to, they are asking is, on its acquisition date, consolidated balance sheet, what amount will True Data report as goodwill? So how are we going to figure this out? We're going to basically determine what did True Data purchase it for, what were the fair values of what they purchased, and what's the difference going to be? Goodwill. Okay? You guys following me? So, what we're going to do here is we're going to show how much consideration was transferred? 10,000 shares at $40 a share, right? So 10,000 shares at $40 a share, consideration 10,000 shares times $40. What is that going to be? 400,000. Okay? Then we need to figure out what is the book value minus the liabilities of what we're receiving. The book values minus the liabilities, cash of 60. Here, I'm going to record this over on the side. Inventory of 145. So we'll, over here on the side, we'll show cash 60, inventory 145. We've also got patented technology 180. we've got land of 200, buildings is 75, land 200, buildings 75, and then we have a liability we're assuming of 360, right? The liability we're assuming is minus 360. So the book value of the net assets basically is going to be 300,000. Let's look at the fair value though, guys. So our cash is the same. Our inventory is up 30,000, right? The patented technology is up 20. That makes 50,000 increase in fair value. The land is up 25. So that makes 75 increase in fair value, right? The liability is, instead of owing 360, we only owe 350. Okay, so we're assuming less liability than what we expected. So we're up 85,000, aren't we? Correct? Do you guys see what I'm saying? So this is a fair value of 30,000 more. This is 20,000 more, that's 50. This is 25, that's 75. But we were assuming 360,000, which is a minus. But now we're only assuming 350, so we're up 10 on that to our benefit. So we've got 85,000 that we're going to increase in fair value. So our book value is 300,000. The increase because of fair value is up to 85,000. Make sense? So basically the difference between the 400,000 and what we're assuming here I'm doing something wrong. I got something in here that I should, book value. Let me get rid of the book value. You know, so basically what I'm doing is I'm showing the book value of everything plus the fair value. Do you see that we have a fair value of all the assets minus our liabilities of 385? So this is the fair value of everything we're acquiring, okay? So if we sold, or we are purchasing it, the consideration we gave is 400, but yet our fair value in the assets is at 385, then what is our goodwill? 15,000. Does that make sense? Does anyone have questions? Another way we could do this, I'm just trying to help you understand, instead of showing the book value and then coming up with a fair value, we can just from the start come up with the fair value of all these items. Cash is 60, the inventory is at 175 fair value, the patent technology is at 200,000 fair value, the land is at 225 now, the building stays the same, guys? Mm-hmm. And the liability, instead of it being 360, is now only 350. Do you see how we can come up with it the same way? The first way, we just took the book value and showed the changes in fair value. This way we can show all the assets at fair value. The difference, since we paid 400 for it, but we're only really getting 385 in fair value of assets, the difference has to be goodwill. Why would we pay more? Because there's some intrinsic benefit we're deriving from this company we're willing to pay for. Okay? So,